Hello, I'm Soleil Valiapan. I'm an angel investor and venture capital investor based in Sydney. Today, I'm going to be sharing more about preemptive rights and how they work in subsequent rounds of funding. So, first, some definitions as always. So, these were touched on in the previous video, but I'll run through them again. So, we've got the cap table, which is a table or a spreadsheet that shows the ownership structure. So, essentially, this shows who owns what percentage and the type of security as well. Then we have the valuation. This is the estimated worth of the startup or growth company. And we can then break this down into a pre-money valuation and a post-money. So a pre-money is what you estimate the startup to be worth before investment. Then you have a round of capital, which is a discrete funding round where a company raises investment from potentially external investors. And then after this investment, then you can calculate the post-money valuation. So this is what the startup is worth after investment. Then we have dilution, which is a reduction in ownership percentage for all existing shareholders. And this is because the company is issuing new shares. And usually dilution occurs after each funding round. Then we have the employee share option plan. So this is a pool of shares that are set aside for employees as a way to incentivize them. And then then I've got in here preemptive rights and pro rata allocation. So this is a new definition that we're introducing. And this is the right, but not the obligation for investors to maintain their level of percentage ownership in a company in future funding rounds. So we're going to step through an example of this because that sounds a little bit like, oh, what does that even mean? So I'll show I'll show an example. We'll walk through an example to see how this works and the calculations. So as a reminder, this is an illustrative cap table of ownership over time. So with some rules of thumb. So the dilution impact for each round should be about 10 to 25%. That's a suitable range. And then for the employee share option plan, this should be about 10 to 20% overall, and you can top this up over time. And then if you are building a VC-backed business, you're likely to be raising every 18 to 24 months. So the graph that we have here shows the founders in the dark pink and then investors in the lighter pink, and then we've got an ESOP allocation here as well. So as you raise capital, you've got the founders who are diluting. You've also got investors. Existing investors will dilute, but then you'll also have new investors coming in as well. So this is just a little bit of a reminder of how a cap table will look over time. So let's look at a cap table from the very beginning before we get started on looking at preemptive rights. So in this example here, I've got two founders where we are assuming that they are equal partners. So of course, equal partnership, you start the business 50-50, but they're at 41.67% each because we have assumed in this example that the employee share option pool has been created prior to raising capital. So they've said, okay, we've got 1,000 shares each. And maybe they bought those shares at $1 or $10 or anything just at the beginning. And then they've put aside an employee share option plan of, they've said 400 shares, which is about 16.67%. And so that means that each founder has gone from 50% to 41.67 to allow for this ESOP. So you're ready to raise your first round of capital. You want to raise $1 million with a pre-money of $4 million. So we did go through this and how to calculate the pre-money, the seed round, the post-money, and the dilution in my previous video. So I recommend you watch that. It's called Dilution Impact of Capital Rounds. I'll also leave a link in the video description below. But we're going to crack on. What is new though, and that I didn't go through in the previous video, is how to calculate price per share. So this is calculated as the pre-money valuation divided by the number of shares before this capital round. So in this example, it's $4 million because that's the pre-money valuation divided by 2,400. So that is the founder's shares, the 1,000 each, and then the 400. So this is the number of shares that the company was in existence before this seed round of capital. So for this $1 million round, we're also going to assume that the founding shares and the ESOP remain unchanged. I mean, as founders, that's the whole point as to why you're raising capital, because you want investment to come from externally. So you're likely to, so from this example, we can see that the founders have diluted by 20% to 33.33%. And similarly for the ESOP as well. So in this example, investor one, we're saying, is the lead investor of the $1 million seed round, and investor two is following the terms of investor one. So $600,000, then investor two is taking the balance of $400,000. That's the $1 million investment. So before the capital round, there were 2,400 shares. And then after $1 million of investment, with the terms of the pre-money being 4 million, we now have an additional 600 shares. So the total number of shares has gone up to 3,000 shares now. We can then also calculate the new ownership percentage for each shareholder. So as I said before, the founders have gone from about 42% to 33%, and the ESOP, they've gone from about 17% to about 13%. And then you can see investor one and two are now on the cap table, and they have a total of 20%, the 12 plus the 8. So, congratulations. You're growing rapidly and you're ready to do your next round of capital, and you're going for a Series A. So, we're going to step through this. So for the Series A, you want a $5 million amount at a pre-money valuation of $20 million. So again, this is a dilution of 20%. And this is how you can also calculate the price per share accordingly, similar to how it was done at the seed round. So a new investor comes in, we're going to call them Series A, and they're coming in to lead the round. And if they are to take the whole round, then they will have 20% of the company. And this shows also what the cap table ownership looks like with this round of investment. So you can see that there's been a 20% dilution to all shareholders, including investor one and two. So you can see that the seed investors, investor one has gone from 12% to 9.6% in terms of their ownership, and investor two's gone from 8% to 6.4%. But remember, the price per their share of their existing shares has gone up, but their ownership percentage of the entire company has been diluted by 20%. But let's assume both investor one and two negotiated preemptive rights in the seed round, which means that they have the right but not the obligation to maintain their equity percentage. So what that means is that they have the right to invest more money and not be diluted by new investors coming in to the deal. So what does this all mean? So where we calculated $5 million, we can see the number of shares that would be allocated to investor one and two on a pro rata basis in order to maintain their equity. So for this example, we've got here for investor one, 90 shares, and them investing basically another $600,000 would enable them to maintain their equity percentage in the company of 12%. And similarly, Investor 2 would need to invest another $400,000, so they would be allocated another 60 shares to maintain their 8%. So that leaves with those two and their taking up their preemptive rights and having an extra allocation of those shares, that means that there's $4 million left for Series A investors. Now, it's important to remember that this is just an allocation. They don't have to take up their preemptive rights, or they may only take them up partially, if any at all. And you can see here on the right, then, if they are participating again in the deal and taking up their preemptive rights, then their dilution levels are taken out and they come back to what they initially invested in. So that's the 12% and the 8%. So let's recap from the beginning. Before raising, we have the founders who have set up their employee share option pool. Then they're raising a seed round, and the seed round of $1 million at a $4 million pre-money, they've got two new investors coming in, so they've got 12 and 8% at the seed round. Then the company's doing so great, it decides to raise again at a Series A of $5 million at a $20 million pre-money. And because Investor 1 and Investor 2 have preemptive rights and they've decided to take up their preemptive rights, they hold their equity percentage. So they are investing again at the Series A, which means that there's $4 million available for Series A investors who are not Investor 1 and Investor 2. So, a couple of things to note about preemptive rights. The first is that they are negotiated in the legal documents, and access to this is not can change over time. So, an example of this, maybe your angel investors or initial seed investors may no longer have preemptive rights when you get to a Series F. By then, because at each round of capital, you've got new lead investors negotiating the legals, things may change. So, for example, at that Series F, it may be that the lead investor has negotiated that anyone below a certain percentage no longer has preemptive rights. The other thing is at those kind of really growth stage deals, angel investors may not have the cash to be able to continue participating at those kind of terms or those dollar amounts. The next thing to think about is if an investor doesn't take up their preemptive rights, what do you do with the allocation of shares? Well, you can offer this to other existing investors. And so, what this does mean is that if an investor takes up their preemptive rights and there are more available, then they can also add to this. And so they can potentially invest more so that their percentage holdings is higher than what they initially invested in. And that's totally fine. Or you can offer it to new investors coming in as well. So the proportion of pro rata allocation can be a signal for new investors coming to the round. It kind of shows, well, how much are your existing investors supportive of you, and it can reflect on what they think of the business. But you can also some investors may be pretty upfront and say, hey, I tend not to follow on because of XYZ. And then just remember, subsequent rounds and allowing for preemptive rights can be really complicated. In this example that we've gone through today, it was based on two very simple priced equity rounds of investment. So I definitely recommend having appropriate legal advice and a very good spreadsheet for the calculations. So here's a summary of just a few things to note when you're thinking about the preemptive rights. It can be a little bit complicated. So yeah, I definitely recommend having a really, really good spreadsheet to understand where allocations should go. So there we have it, preemptive rights in subsequent rounds of funding. I know this was a little bit more of a technical topic that we were going through today. So if you would like access to the underlying spreadsheet with the formulas, please get in touch with me. The best way is probably through LinkedIn, but maybe you can leave a comment below as well. And I'm very happy to share that spreadsheet. These things are a little complicated, and so sometimes stepping them through is the easiest way.